Hello everyone. When markets experience a downturn, it's easy to feel panic set in. But the key message here is simple: don't panic. History shows us that markets always rise again after a crash. This slide illustrates how, despite drops, the market index consistently recovers over time. For calm investors, understanding this pattern is crucial to making informed decisions without impulsive reactions. Staying patient and focused helps navigate turbulent times with confidence. If you have questions or want to discuss further, feel free to reach out to me at the email provided. When markets crash due to wars, pandemics, or other crises, the natural reaction is often to sell quickly to avoid further losses. But this fear-driven decision can be the biggest portfolio killer. Selling during a downturn locks in those losses and prevents you from participating in the eventual market recovery. On the slide, you can see the stark difference in outcomes based on how you react. Panic selling at the bottom can result in an 85% negative impact on your portfolio. On the other hand, if you hold your position steady through the crash, you can break even over time. Even better is buying the dip, investing more during the downturn, which significantly increases your chances of winning and growing your portfolio. The key takeaway here is to resist that impulse to sell out of fear and instead stay focused on your long-term goals. The market does recover, and staying invested allows you to benefit from those recovery rallies. Let's take a closer look at the history of major market crashes and their recoveries. First, the Great Depression from 1929 to 1932 saw the market drop by a staggering 89%. It took about 25 years for the market to fully recover and reach new highs, which shows the importance of patience during downturns. Then, the dot-com bust between 2000 and 2002 caused a 49% decline. Recovery was faster this time, taking around 7 years, reflecting changes in the market and economic conditions. The global financial crisis of 2008 to 2009 resulted in a 57% drop. However, the market rebounded to new highs by 2013, demonstrating strong resilience. More recently, the COVID-19 crash in February to March 2020 saw a 34% dip, but the recovery was remarkably swift, with the market bouncing back within just 5 months. These examples clearly show that while crashes can be severe, history proves that markets do recover over time, rewarding those who stay patient and focused on the long term. Warren Buffett famously said, "Be greedy when others are fearful." What he means is that market downturns, though often scary, can actually present the best buying opportunities. When prices fall sharply, world-class businesses can be purchased at a significant discount. For example, if a stock normally trades at 100 rupees per unit, a 30% market crash would reduce it to 70 rupees, and a 60% crash would bring it down to just 40 rupees per unit. These lower prices represent incredible value for investors who are willing to act when others are hesitant. Essentially, distress in the market creates a discount on quality companies, providing a chance to invest wisely and potentially reap significant rewards over time. Here, we're looking at what happens when you choose to invest more during a market dip, based on historical data from the S&P 500 and Nifty 50, including crashes in 2008, 2020, and 2022. The initial investment is 10 lakh rupees. Strategy A shows what happens if you panic sell when the market drops by 40%. This results in locking in a loss of 4.2 lakh rupees, meaning you realize that loss instead of waiting it out. Strategy B takes a steadier approach, holding the position without selling during the dip. After 3 years, this results in a gain of 6.8 lakh rupees, demonstrating the power of patience and not reacting emotionally to market downturns. Now, Strategy C is the champion approach. Here, instead of selling or just holding, you invest twice the amount at the dip. By doing this, after 3 years, the returns grow substantially to 18.4 lakh rupees, highlighting how market dips can actually be the best opportunities to increase your investment. The key takeaway is that the dip itself isn't the danger, it's your reaction to it that matters. Viewing dips as opportunities rather than threats can dramatically improve your investment outcomes. Let's talk about some essential investor mantras that can really guide your approach to the market. First, remember that time in the market beats timing the market. Even if you start investing at the worst possible moment historically, you'll still outperform simply sitting on cash for a year. It's about staying invested over the long haul. Next, think of a market crash as a sale on great businesses. Imagine if your favorite store suddenly offered a 40% discount. Would you panic or see it as an opportunity? Treat market downturns the same way. They're chances to buy quality assets at a lower price. War and crises might shake things up temporarily, but economies are built to endure. Historically, after every geopolitical shock, markets have bounced back. Human enterprise and innovation keep moving forward, so it's vital to keep that perspective. Finally, volatility is simply the price we pay for long-term returns. The short-term ups and downs might feel uncomfortable, but they pave the way for outsized gains down the road. Instead of fearing turbulence, embrace it as part of your investing journey. When it comes to building lasting wealth, the key is to stay calm, stay invested, and stay wealthy. History shows us that the investors who created generational wealth didn't panic and sell during market crises. Instead, they held on to their investments and often took the opportunity to buy more at lower prices. Since 1900, the market has consistently recovered from downturns, delivering an average annual return of about 10.7% for the S&P 500. This demonstrates the power of patience and staying invested over the long term. In fact, there have been 0 times where patience has failed long-term investors. Remember, past performance is educational, not a guarantee. It's important to invest wisely and seek advice from a registered financial distributor, like an AMFI-registered MFD. You've got the knowledge now, it's time to act on it thoughtfully. Here's how you can reach me. I'm Shivaputra MC, an AMFI-registered mutual fund distributor with the ARN number 328438. With over 20 years of experience in financial services and capital markets, I'm authorized to distribute all categories of mutual funds across India. My goal is simple: to help investors stay calm, stay invested, and build lasting wealth. If you have any questions or need assistance, feel free to contact me at 998-058-8383 or email shivaputremfd@gmail.com. Remember, your wealth is best guided by experience.